How do dividends affect covered call adjustments? Have you ever wondered how dividends can impact your covered call strategy? Today, we will break it down in a straightforward way. A covered call is an options strategy where you own shares of a stock and sell call options on those shares. This approach allows you to earn income from the option premium but limits your potential gains if the stock price rises above the strike price. Now let's talk about how dividends come into play. The ex-dividend date is the key date to keep in mind. This is the cutoff for receiving the next dividend payment. If you hold the stock before this date, you will receive the dividend. If you do not, you will miss out. As the ex-dividend date approaches, the risk of early assignment on a covered call increases. This means that the holder of the call option might choose to exercise the option early to capture the dividend. If the call option is in the money, meaning the stock price is above the strike price, the chance of early assignment is even higher. This could lead to you having to sell your shares before the ex-dividend date, costing you the dividend payment. To manage this risk, many investors adjust their covered call positions before the ex-dividend date. One common adjustment is rolling the call option to a later expiration date or a different strike price. Rolling involves buying back the current call option and selling a new one with a later expiration or a higher strike price. This strategy helps you avoid early assignment and allows you to keep both the dividend and the option premium. Another adjustment is to keep an eye on the moneyness of the call option. If the call option is deep into money as the ex-dividend date approaches, the risk of early assignment is at its peak. In this case, you might consider closing the position or rolling it to reduce that risk. Dividends can also affect the pricing of options. As the ex-dividend date nears, call options may lose value while put options may gain value due to the expected drop in the stock price by the amount of the dividend. This pricing effect can influence when and how you adjust your covered call positions. In summary, dividends introduce timing and assignment risks to covered call strategies. Adjustments are often necessary to manage these risks, such as rolling options or closing positions before the ex-dividend date. This way, you can maintain control over your stock positions and maximize your income from both dividends and option premiums. Understanding how dividends affect covered call adjustments is essential for effective risk management in options trading.